Hello there. Um, Welcome to the 2021 review and 2022 outlook from RIM. You can see me there at the bottom here of your screen. Uh, I, I will try something different today. Instead of writing a long letter making reference to very complex charts that are very difficult to follow, I am recording what I believe are the major points of attention for 2022, but I will start showing what happened in 2021, and then, of course, end with how I believe that most investors at RIM should be positioning their portfolio. In other words, which strategy investors should be favoring. Um, the I will try to do this in a way quite fast. So if you are need to come back, pause the video, come back. You can always ask me questions later. I will gladly answer your questions. We can talk over the phone. We can do a video call. But the idea here is to summarize 2021, talk about what are my biggest worries for 2022 and how to position for that environment. Okay, so let's start with 2021, which I believe was a risk-on year. The market clearly favored risk-seeking categories or strategies. I will show this through RIM's historical performance spreadsheet that you have access to most emails that I sent you. Then for 2022, and actually for even further years, what we'll be seeing is still all the stimulus that were related to COVID-19, which they triggered a lot of economic and market distortions. For instance, there was, of course, an unprecedented transfer to persons and businesses. When I say transfers, I mean money, cash. And there is a chart from the FRED system that I'll show you that put this in context. This transfer triggered a couple of different reactions, if you will. Consumers, they bought a lot of discretionary items. Businesses, though, are taking, in my opinion, that's what I see through the companies that I follow at RIM, a wait and see approach to investments. I'll show you models for Thor, an RV manufacturer, in Trinity Industries, that they manufacture and they manage a huge fleet of rail cars. You're going to see how different they are. Another way to look at the same dynamic, especially for the industry here, is see that the overall trucking volume is not back to pre-pandemic levels yet. The data from the American Trucking Association will show that, and the data from the CAS indexes will show, though, how high prices are. They are absurdly high. So the distortions here are, there was consumption, but volumes of real industrial things are not that strong. However, prices, because of an urgency in obtaining whatever people wanted for the end of the year, plus issues at the supply chain, led prices to the record levels. Now, there is a couple of things in conjunction that are by far my biggest worry. The Fed policy now is leading to real interest rates to record lows, meaning it's negative now, to record negative lows, if you will. I'm going to show these calculations for you. Now, the biggest consequence, although I have shown you that zero interest rates or negative interest rates in our case as savers doesn't help us. The one thing that it does, that is for me the highest risk in the economy right now, is a housing bubble. I believe we are in a housing bubble 2.0, and Credit Suisse, not Credit Suisse, sorry, Case-Shiller index will show that for you. The one thing that is surprising, however, with housing prices so high, and I'm going to show here how high valuations are, if you will, it's surprising that at least one of the two major consumer confidence indexes, the University of Michigan, is actually pretty low. I'm not sure about what to do this because the conference board is not that low in terms of their index, but I want to be aware and show you this might signal that all this confusion is actually making people unsure about the future, and this is reflected on that consumer confidence. Now, it leads us to how do you position yourself for 2022? Quite frankly, there is not really a lot of change from 2021. It's just that it is more extreme now. I will show this how some very broad market valuation levels, how high they are, through the Advisor Perspectives website. They have some very interesting calculations there, very easy to follow. It might be something that you want to take a look from time to time. So I will give you the same advice that I gave in early 2021, which is now favor the long short strategy. Clearly, I was wrong for 2021, so take this as with a grain of salt. But I do what I believe is best for my average client. I'm going to show that Odysseus, which is the portfolio build up tool at RIM, is showing a big number of shorts in the portfolio. This is historically high. And of course, this has a consequence in the allocation. And then I will end with the RIM's allocation decision table, which is at the end of RIM's presentation, which is the one that I usually use to have a conversation with you in terms of what we need to be thinking when deciding which strategy to use. Okay, so again, what I just said, I will then say again now, but now I'll be showing charts. So let's go to this first point here, which is the market favored risk-seeking strategies. So the way to look at this is by coming here to this is the spreadsheet that you receive from me. There's always a link to the spreadsheet, to the presentation and RIM's modus operandi. Now, and here is what it shows. So let's focus here. So it shows the long short strategy in the year's return. So 2018, 19, 2021, 2018 was the first year that I was able to re-implement the same strategy that I was using at Rational, the hedge fund, for almost 8 years. So then I'm rebuilding track record, if you will. And here you see what happened in 2021, a decline of 4.5%. Now, if you look at the long-only strategy, it was almost 13%, while the long aggressive was more than 20%. Those are in gross return, in gross terms, because each account pays different fees depending when they started. So I show this in gross return, so we can also compare this with like an index like the Russell 2000. Remember that for 2021, the S&P 500, because of the mega caps in that index, was up almost 28%. Right, so this 14% here is already high, especially after a 25 or 20% returns on the prior years, but other indexes were even more aggressive. Now, so this tells me that the market was favoring more aggressive strategies, risk-seeking strategies. I want to call your attention here. There was this box here that I leave this as a comment so people can think about those returns or these returns here in relation to the risk that each one of those strategies is incurring. In other words, if you get an index, it is by definition 100% exposed all the time. So if you look at the long aggressive, since inception has been almost 100% exposed and almost 100% during 2021. So the last year here, 3 years since inception. Now, if you go to the long only though, right, although this is a strategy that has returned since inception 13% versus 11 for this index, for instance, the average exposure is only 40%, right? So, and consider that the other 60%, which is then cash, was receiving zero, or most of the time. There were some interest rates there in 2018-19, very low, but nothing close to what has been normal, which is inflation plus 2%. So in a year like 2021, when inflation was close to 7, interest rates that we should have made was close to 9%. Right now, if you go to the long short strategy, this is even more extreme. In other words, the long short has been since inception close to zero in exposure, meaning on average 100% in cash. Now, we should have received inflation plus 2%, which is, let's say, 4.5%. Take the 50 basis points from the broker, it's 4% per year. So the 6% here should have been more than 10. Now, 10 close to 11, assuming almost no exposure on average, right? So again, the risk return of those strategies are very different. But also remember that we have been punished as savers by low interest rates. I'll talk about the impact on housing later, but keep in mind that it does matter for our returns. What can we do about it? Nothing. That is what happens in those instances. There is really not much that we can do. Okay, so let me go now back to the presentation. Go to the now different bullet points about 2022. So what happens now? So let's start to take a look on the size of the stimulus from the government. When the pandemic hit, the reaction was very fast, and quite frankly, it might be okay in retrospect, meaning that when people go back in history and say, as the pandemic hit here in the first quarter of 2020, the reaction was appropriate. I'm not sure, but maybe it was. In other words, maybe the alternative was a depression and this avoided it. But what this chart is showing here, let's look at the back, at the bottom here, is the size of the government deficit. I'm not going to go to the description of each one of those lines, but you can see it here. I can also send you the link for this chart. It updates automatically. It's at the FRED system from the Federal Reserve. It's an excellent website. You can download this with APIs. You know, they are building a very interesting, solid database with free access. It's really fantastic. Now, so what we can see though is that if you go back here to 2008-9, when Lehman went bankrupt, the US economy was going to almost a depression. The financial system was literally bankrupt. The government used close to 11, 10% of its GDP, if you will, in transfers. Transfers meaning a deficit from the government, by definition, has to go to 3 places: personal savings, corporate profits, or to somebody else outside the country. In other words, a deficit on the balance of payments, goods and services. In the US, we know it's mostly in goods. Okay, so that was what happened during that massive economic crisis. Now, fast forward now, the government sent to the population more than 25% of GDP. This is equivalent to World War II levels. When you go, you know, the same measures were not around back in the 30s and 40s. But some historical books try to make those calculations, and those numbers are close to 25%, which means it was huge, right? So then in the first quarter of 2001, it was a second round. So instead of this reversing back to, let's say, which is for me is already very high, close to 4 or 5% of GDP in terms of stimulus, it stayed there. Now, even the months that were less aggressive, if you will, is still close to 10% of GDP. Okay, this is a huge amount of money. It was never done before. No one knows how much impact this will have and for how long. What I can show you, though, is, again, let's go there, that it triggered at least a couple of things. from the consumer side, they are buying a lot of expensive discretionary items. Think about an RV. For businesses, though, it's not the same thing. It's not that CEOs went out and said to their employees, go out and expand. So the way I see this is by looking at specific valuations or in specific companies that I follow. So these store industries, again, you know that my templates are super detailed. And here the focus is not even in the valuation per se, is of course in a few specific parts here for the company. More specifically is literally here, look at this chart on the right, which is the number of units sold by Tor. So here are in North America, we're going to have those super solid years here, if you will, in terms of units. But in terms of sales, because this includes also inflation and cost pass-through, those are record years. Right? If you look at an industry-wide kind of numbers, and I have it here, for instance, that's what you see here. These blue dots are RV shipments per 1,000 people in the US. And when I say 1,000 people, it's people at a certain relevant age groups that you see here at the top, right? So people that would be prone to buy an RV. This is already, we're going to see very soon the final numbers, but 2021 is going to be a record year in sales per 1,000 people in units, right? These, of course, transferred to Tor. They are making a lot of money. Now, and if you look at the estimate charts, and here's why we were able actually to buy it pre-pandemic or around here, was because they were trying to stuff channels here to do an acquisition. It's a different story, but they were already in their own recession, if you will, when the pandemic hit. And of course, everyone initially thought that earnings would be terrible and stay there. But of course, it rebounded. And here's the surprise. And here is what the market usually does. It follows earnings very closely, giving us the opportunity to buy, to sell. It's getting cheaper again. We might be able to buy this because the market might not be seeing how big this company will be with a lot of the insourcing that they are doing. They are buying a company here and there in their supply chain, so their earnings will tend to grow more than the sales of the company itself. But again, what you can see clearly is that consumers, and again, you're talking about RVs, things like this, and consumers were really keen to buy expensive discretionary items. Now, if I go and open a very similar template, you're going to see again, it looks like the same company, but that's Trinity Industries. If we go to the inputs page, you're going to see it's a different company. What this company does is they manufacture and sell, but also lease rail cars. So what you see here on the right, in blue bars, is their own fleet of rail cars, right? And here is in red is the ones that they manage for others, right? So this is very industrial, very long-term assets. And if CEOs in overall were as excited as consumers, what we should have seen is it's an increase already in 2021 for rail car delivered. So let me show you more in a long-term chart here. Again, blue dots are deliveries of rail cars since the 60s in the US. So this was 2020. We say, well, okay, it was a crisis, but this is going to be 2021, right? Not really an improvement, right? Again, very different. RVs would be here at record levels, not investments. If I look at companies that produce trucks or pumps or whatever is industrial, I see something similar, right? There was no equivalent to the consumer side, which I see on RVs, ATVs, motorcycles, mattresses, furniture, whatever is discretionary, expensive, we saw a peak there. Okay, so very different reaction to what happened uh, from the transfers that the government said made. Now, it would be all okay if those transfers have caused some kind of push into the economy in volume terms, right? Because one thing is to cause price increases. What you want to see is volumes. Want to see tons transported to increase. So let's take a look on the ATA charts, meaning the American Trucking Association charts. So they go back to the 70s. That very thin line here is the monthly number that can be very volatile. So the thicker blue line here is the last 12 months. And what you can see here is annotated presidents that you can see here. You can see recessions, and you can see events that cause recessions, right? So for instance, the 73 and 79 oil shocks that not only oil went up, but at the same time, housing collapsed. And by here, by the late 70s and 80s, inflation was so high that Volcker raised interest rates to more than 20%, right? So, and again, here is the housing recession in the 90s, the 2000 dot-com bubble burst, and what I call here the quadruple recession, which was housing, oil, the market, and the financial system are all at the same time, or in those years, as if you were superimposing a housing and a market crisis here at the same time. And now, who knew, right? A virus. So a crisis caused by a virus. And I want to call your attention to this part here of the curve. In other words, let's come here and zoom in, right? I have a rhetorical question. You can read this later, asking what would cause the next recession, like a virus, right? Never thought about this. But here's what happens. So the crisis comes, tonnage volume goes down, but it's not back, right? So in other words, it's, eventually it will recover. But my point here is that we didn't see that yet. Now, conversely though, if you look at those red dots here, that's another index, is the CAS transportation indexes. Measures things differently. Here is their volume. Again, volume goes up and down, but again, no peaking volume, harder to see here because of the scale. But those are the expenses in red, and here it tells you how much inflation there is actually in reality, right? If this is volume, and they all start at 1 back in the 90s, and one is still a little over 1 here, while the other is, it's, if we normalize here 3 or 4, you can see that the delta is actually price increases. But my point is that recently, this expense index went to very high levels, implying by this yellow line here a very high year-over-year increases, and this line will go up probably over 30%. It's going to be record in terms of price impact. So again, I don't see a lot of volume increase, but I see price. So that's another point of attention from the COVID government impact in the economy, right? So we can now go again back to this and say, so what then? Well, the one thing though that the government did to help it fund all those transfers were to put interest rates at 0 in nominal terms. So let's go now. This is probably the most complex chart that I have here. So follow my pointer here, so I can explain what it is. This chart I started many years ago by looking at this yellow line here, which is the Fed's fund rate. And remember that I told you that Volcker rose interest rates to close to 20%. That's it. That's what it represents. But what he was doing in all the other peaks that you see here was the Fed trying to have the Fed's fund rate, which is the reference rate, a little above inflation. I call this normal interest rates when they are on average around 2% above inflation. So it's, those are hard years, or hard numbers to achieve, because as you can see, inflation, which is this pink line here, is super volatile, has always been. I think we had the false impression over this year here, a couple of decades, that inflation was always under control. It's not necessarily true. On average, it was kind of low, around 2%. But prior to those 2 decades here, it has been all over the place. Now, what we saw, though, for the first time is inflation and real interest rates, if you will, going in such a different direction on purpose, if you will. In other words, when we had this blue line here going to negative, meaning this is the real Fed's fund rate, meaning yellow line less the pink line. Okay, so if you have inflation higher than the Fed's front rate, we have negative real interest rates. Those peaks were achieved when inflation ran ahead of the Fed, or the Fed thought inflation was coming down and lower rates because the economy was in a crisis. Here again, this is in the midst of the first oil shock, but it was not necessarily aiming to put the Fed's fund rate at zero. Now you fast forward after the bubble from Greenspan, when the financial market collapsed, rates stayed close to zero for years. I'm going to show you this, how damaging this was actually for housing. They tried to take off, and then the crisis came. Now we are in this weird situation where inflation is quite high. It's back here to what we saw in the late 80s, if you will, while interest rates are being left at zero. The government has no alternative. If this goes up at 6%, 7, 8, 9, the government cannot pay for that interest. So this is really worrisome, because no one knows what a prolonged negative real Fed's fund rate will do to the economy. So this worries me, because we never saw it. And I don't think that was ever the intention, to make this that negative for so long. Now, the immediate impact, if we go back to the next bullet point, was the impact of rates on housing. And that's what worries me the most, by far, the housing bubble 2.0. So let's see the Case-Shiller index here, if you will. This is a chart that you probably saw before. And what it shows, again, let's focus in a few lines here. The major index is this black line here. The Case-Shiller index, it's 100 in January of 2000. This line here, this purple line, is also 100 in 2000 and moves up and down with inflation. So whatever moves around that line would be adjusted for inflation. If it moves faster, it means it's now higher than inflation. If it goes below, of course, it's below inflation. Now, what we can see is, what we can calculate actually, is the delta between the black line and the purple line, and scale here on the right, because then it amplifies the scale and tells a better story here in terms of bubbles. So when Greenspan lowered interest rates after September 11, he was super worried about the economy. He thought the American population would get depressed with all those ugly scenes that everyone was seeing on a daily basis, lowers interest rates. But what he did is that housing that was coming already from a strengthening point, because the 90s were very good for the US, it was cleaning up the early 90s housing recession. It just took off in terms of prices, and then houses were around, on average, 55% above the inflation line. Now, here's Greenspan saying, I don't see a bubble. Of course there was. Now we know what happened. Prices collapsed. The financial system was exposed to these prices. It collapses too. And ironically, around here, around 2011, 12, housing prices touch the inflation line. In other words, the dashed uh, uh, black line here touched the 0% line, which is also this dashed purple line here. That would be the 0%. In other words, housing was back to inflation. Here's when I think the Federal Reserve really missed an opportunity to normalize rates and prevent what was already happening, which was housing again going up higher than inflation, forming another bubble, if you will, which was still below the prior one until the recession hit. Now, we are all aware of housing prices. Everyone has a friend that sold a house for twice the price that they thought they would be selling that house a few years ago, maybe a couple of years ago. And houses are now, and might be even go even higher, but it's more than 65% above the inflation line. Now, this is not a forecast, it's just like a simulation. Even if housing prices fall for 5 years at 5% per year in nominal terms, and inflation keeps going up, it will still be around 15% above the inflation line 5 years from now. So how will this be corrected? I don't know. What I know, though, is that this asset is the most important asset for the American household. And if it fails, it might really make a lot of people super worried about their future, which brings me again to the next point, which is the consumer confidence from the University of Michigan. So if we look here, and now I'm going to show you a chart directly from FactSet, is this here. The yellow line is University of Michigan consumer confidence. And here's where we are. And this is very strange for me, though, because markets are very high. I'm going to show, which is, again, people are feeling rich in that front. And houses are also very high, which means that people are always also feeling very rich in that major asset. Now, but maybe the average person is feeling that there is something wrong, there's something off, that they're not as secure in their job. Now, the conference board index, though, is much higher. So I'm not really sure. So one of those two obviously is wrong. The delta has been high, but now it's at record levels. And it's hard to know what we should be make about this. Another point that I want to show you are those charts here, which for me are also very interesting because they were supposed to be inconsequential. They are also from the University of Michigan. Is what they call buying conditions. In blue is the buying conditions for houses. Now, this one, actually, you can see how it makes sense. It was very, very high, meaning it's very difficult to buy at the peak of the 05-06 housing bubble. Then it declines and stays at very favorable levels, if you will. It starts to go up. Again, during the pandemic, maybe there was a lot of people trying to sell houses, and now it went to record highs. The one thing, though, that is very different, again, never seen before, are those less telling, much less important indexes, which is this one here for auto, and the other one is for consumer goods. So those are for household goods in red, and here are for auto prices, for vehicles, if you will, here. That's what it means here in orange. And again, this is very strange. So again, the crisis comes. There was obviously a lot of cars. I did buy a car here at the end. It was actually very promotional at the end of 2020. It was already recovering, but it was a good time to buy a car. In 2021, though, it went to these absurdly high record numbers. Now, even more surprising, because it should be easy to buy a refrigerator, is this. I mean, it's difficult today to buy regular household items. Very surprising. Now we need to watch this. The housing one makes a lot of sense, but those two, we know what happened, right? I mean, the stimulus was very strong. A lot of consumers triggered their discretionary item buys, and the supply chain clogged, the global supply chain. And this is maybe one of my biggest critiques to the stimulus, because if it was the stimulus were the reason why people decided to buy so many discretionary items, in retrospect, it's going to be seen as a mistake because, well, if during a pandemic you're expecting disruption in the supply chain, in the global supply chain, why would the US, this huge country, give so much consumption to lead people to buy record numbers of everything? That's not the time to do this, right? So again, so let's see how this will be seen in the future. Now, okay, so I showed you all those major points here that are my points of concerns, but they are all due to the one trigger, which were all the stimulus related to COVID-19, right? So this is where we are now. So the question is what to do now with equity investments, right? Of in more specifically the one that you have here at RIM. The the first point that I want to show is it's not what I do on a daily basis. I focus on the 65 companies that are part of RIM's circle of competence. But of course, I'm aware of some very obvious calculations about overall market levels. Let me show you what I mean by that. So if we go back to the what I have shared with you in the past from this website here called Advisors Perspectives, they do calculate what they call the Buffett indicator, and in a very raw format is all corporate equities, all the value of corporate equities divided by GDP, right? So again, you go back to the 50s and you see here the go-go years of the 60s, the 2000s, and now where we are now. Now, this is done for, you can do with a different index, for instance, the Wilshire 5000 index, which is a very broad index. And if you compare those two, they're very similar. That's what they're showing you here. Now, let's go and look at one more chart here. What the authors do here, they say, well, what if there is a trend line in those numbers? Because it's so much higher than before. A reason could be public companies are gaining market share. Look at the size of the major US companies, Amazon, Apple, Netflix, Google, Facebook, right? They are super dominant companies in their sectors, more than maybe in the past. I'm not 100% sure because there's a lot of concentration in oil, steel, etc. in the past, but this is so old that maybe there is a higher concentration of value on the public market. So if there is a trend line, what they do is like, well, let's measure then this index to the trend line. So even if you do this, you still see very high levels as of now. Now, what they also do, they calculate what they call their valuation ratios. So there's like four valuations ratios. They have very detailed explanations for each one of them. And again, it's kind of like the same idea. I'm not going to go to the same materials, but they are pointing to high numbers. If you do by a geometric mean, some of them highlights more the peaks. And if you do an average of those valuations, be it like with an average or geometric mean, you see that we are at very high levels. I mean, there is no way to put this differently. After the run in 2021, in at least the average of all those metrics are at record levels. Does it mean that's going to fall tomorrow? No, of course not, right? I mean, no one knows, but I'm just saying, this should make you pause, right? You should be looking into this and say, well, how do I position myself if you knew nothing more? But we do, though. right? Let's go back here and go to Odysseus and show how the methodology is seeing longs and shorts, right, at this moment. So again, it's a chart that you are familiar. For those that didn't see yet or are missing Odysseus, here's it is, right? If you remember, it is a series of uh, uh, models in coding. This is Python. Here are variables, and there's just the whole structure. What matters really are the charts that I plot here on the right. And this is something that you're super familiar with, is the number of shorts over time in this simulation. Remember, what I want to do with Odysseus is initially what I tried to do was let me simulate something that shows a great return and see if I can deliver this in practice. I'll never deliver what you see here in this blue line, and the scale here is actually log based too, because it's so high. I wouldn't even see here those zigzags of 2016-19 in a regular linear scale. But the point is, all this is done based on fundamental analysis. In other words, I have 65 companies that I follow, and what Odysseus does every day checks, should this company be a long? So if yes, it's a long here. That's the number of longs over time. And if it's too expensive, it should become a short. And here are the number of shorts. Now, and clearly you can see those waves of shorts with waves of markets in terms of their peaks, right? In other words, look at 2016 and 19, and if you go back here, you see here the correction 2016 and 19 too, right? And then that's when you see Odysseus simulating a reduction in the number of shorts. Now, it also did in 2020 and told me, look, you should have bought more than 20 companies. I bought like 16 out of, instead of those 20 something here, 23 that it tells me to buy now. And then quickly sells a lot of them, right? And then increases back the number of shorts. This for me is the equivalent of all those indexes that you saw about market valuations, is the number of shorts. Now we were at 28. We just closed Best Buy. You got the portfolio action on this, and this is what really gives me pause: is the number of shorts that Odysseus on the long short strategy tells us to carry. Now, so you also know that there are a lot of rules regarding sizes of individual positions and overall exposure. So you can see here the green area is the total size, or 30% in terms of exposure from the long side. Because I have only 6 longs, they can be at most 5%. Look here in this text format, while the shorts, there are so many, 27, that they are small. They're 1.85 because they can be together at most 50, because another rule is the long short strategy cannot be more than 20% net short. In other words, the red area cannot be more than 20% bigger than the green area. So here's the net scale on the left at minus 20. Again, coding is excellent to simulate and build portfolios and eventually implement trading instructions, right? But more than anything, what this gives me is long-term and historical perspective. Almost 30 shorts is super high. So that's why I believe that's time to be cautious. Again, I said this at the beginning of the year. Obviously, that was not the case for 2021, but I do not put positions assuming that you're going to go to record number of shorts and valuation indexes, if you will. So let me go then to the last point here, which is the RIMS allocation decision table. You should be familiar with that, and that this is that one table that I always bring during discussions with new clients or current clients when we are deciding which type of strategy we should be favoring: the long short, the long only, the long aggressive. Those are the major three. And I always say that we have to be paying attention to our drawdown protection desire, in other words, fear, or our desire to get potential for appreciation, our greed. It will depend. Your decisions should mostly be based on where you think we are in terms of overall valuations. If companies on RIM's circle of competence are mostly overvalued, which they are now, I think you should be favoring fear or drawdown protection. Eventually, we were very briefly in early 2020, and we did act through the long short strategy. Not that people, a lot of my investors, we had time to move to those strategies, but imagine if we eventually walk into a recession, then we will have 30, 40 longs, and it will be time to favor potential for appreciation or some greed, right? Now, I believe that's where we should be focusing, right? We should be focusing on the long short because it has more drawdown protection. Yes, there is less potential for appreciation, but this will be a different time that we should be favoring that part. Now, if you read the description here that I'm highlighting here, that was exactly what happened in 2021. It says that a reduced number of longs and a high number of shorts could lead to appreciation during market downturns. Again, when the market falls, usually it goes up, as it did like in November of last year. But a persistent bull market would lead to a slow decline as net short exposure is limited. A 4.5% decline, 5% decline for me, it is a limited decline from a market that can go down easily 40, 50, 60%. So that's exactly what happened in 2021. We were looking for drawdown protection, and the market, of course, engaged in a persistent bull market. Can it do again in 2022? Of course it can. But my job is to truly advise you on what I think is the most consistent way to position your investment with me, which is at this moment the long short strategy. If the person though is looking for other exposures because I don't have full visibility in your portfolio, yes, we can of course have you in a different strategy at times that might not make sense, but for your portfolio, it does. So again, I'm always open to that. But in general, I like to make sure that my investors are aware of what I believe is the best approach for that moment, considering nothing else. And right now is a long short strategy. So that's it. I will, I'll go back here to the bullet points that we started the presentation with. I invite you to reach out, ask further questions, and please send me your feedback. I would love to hear your feedback in relation to this format, if it needs to be shorter, longer, more detail, less details. But I will try to have some of the communications during the year in this format because I realized that the very extensive text with so much information is very hard to consume. Sometimes a presentation format might be better for the average client. So that's it. Happy 2021 or 2022, and looking forward to engage with you in interesting conversations during this year.